Hey, it's Rob. Welcome to Everyday Investor, the hottest investment show in the world. That's right, I said it. I don't care who knows it. We all want more time to spend with family and friends. We want time to engage in a purpose greater than ourselves, have some sort of meaning in life. The challenge is we spend most of our time working to make money in order to live. Let me say that again. We spend our precious time working to make money in order to live. Imagine a life where money could make you money to live in order that we could work less and have more time for the things that matter most. Well, you can. Learn how from everyday people who are making this a reality. Don't go anywhere. We'll be right back. Coming up, Peter Politis teaches us how our money can make us money investing in real estate development.
We're buying land in major urban areas, so whether it's Toronto or the GTA or in South Florida on the water in Miami, different places, we're buying prime pieces of land, and that is the asset that we own as equity. So we're not lenders, we're not giving people money, we're coming in and we're co-owning property in partnership with our developers.
Everyday Investor is brought to you by ProFunds Mortgages, fixed returns, real security. Clover Properties Rent to Own, invest with a purpose. Sam McDaddy Real Estate, full service brokerage for all your buying, selling, and investing needs.
Hey, it's Rav. Welcome back. Remember, whenever you're faced with any type of investment opportunity, you always want to ask the 4 questions to start. Number 1, what is the return on investment? Number 2, when do I get that return along with the investment amount that I put in? 3, what is the minimum amount needed? And 4, what is the risk, the worst case scenario? I'm super excited about this show. I have a good friend on it. We're going to learn how we can make money investing in real estate development. I'd rather have no one else teach me on that subject than Peter Politis from Greybrook Realty Partners. Pete, thanks so much for being on the show.
Rob, my absolute pleasure.
You know, I am very grateful for you, for being a friend to me, Sinead, the kids. We met a long time ago. You know, it was probably about 8, 9, 10 years. You've been coming on the show, you've been nurturing me, you've been nurturing the audience, but what I always find so funny is me, who claimed to be Mr. Real Estate, first property with Mama Tour at 16 years old. I'm now 47, 31, 32 years later. When Peter was teaching me this concept of investing in real estate development, it took you 4 or 5 times for me to get it. And that's not because of you, it's because of me.
I'm just a very patient person, Rob. That's all I can tell you.
Yes, no, it's amazing. And since then, I'm in numerous deals, exited deals, and so grateful that now I'm even part of the Greybrook family by way of business development and PR, and it's not hard to do. So thank you for all of that from the get-go. Before we get into this topic, what's Peter been doing? What have you been up to other than being nominated top 40, under 40, most influential in Canada? I mean, how did that happen? That's amazing. I'm not surprised, but talk a little bit about that.
Yeah, it was a good honor, and when I talk about it, it's kind of an individual honor that shouldn't be an individual honor. I mean, there's 65 people in the Greybrook Realty family that kind of helped make it all happen over the last 15 years. So, this is my 15th year now at Greybrook. So. Wow. Time really flies, and it's nice to get recognition, not just for myself, but for all the people who've been putting a lot of hard work into what we've been doing for the last decade and a half.
Yes, and I love your family. I love, your dad, George, and all your family's kind of been in the real estate world. But Peter took a little bit of a different, approach to it. They're more into the buy, sell, and invest for themselves, and you got into the development space. So how did that happen?
Yeah, I mean, like all good things, I fell into it really, and it was either be a baseball player or this, and I just wasn't good enough to be on the Blue Jays, unfortunately. So here I am, and really, for us, it's allowing kind of individual investors to buy and partner with kind of the biggest large-scale residential and commercial developers, not just throughout the GTA, but in Montreal and in South Florida and across various markets where, they can kind of get returns like they're some of the biggest developers and institutions in the world without having to do all the work, write checks of tens of millions of dollars or hundreds of millions of dollars in some cases, and go out and get a construction loan and really share the value creation that is development.
So how does it work? Talk to me a little bit about how does real estate development work? You are an incredibly smart guy and know all different kinds of strategies. Why do you like this strategy in making money? So how does it work, and why does Peter like this strategy?
Yeah, I mean, the two kind of how it works and why I like it are kind of one and the same, in the sense that at the end of the day, at the core of what we're doing, we're buying land in major urban areas. So whether it's Toronto or the GTA or in South Florida on the water in Miami, different places, we're buying prime pieces of land, and that is the asset that we own as equity. So we're not lenders, we're not giving people money, we're coming in and we're co-owning property in partnership with our developers. So I start with a really great asset that is land. And I'm not waiting on passive appreciation where I'm buying something, but I'm not really adding any value and hoping that the market tells me it's worth more tomorrow. Let's say you buy your house, unless you do some renovations, additions, or whatever, you kind of buy your house, 1, 5, 10 years later, it's worth something more than you bought it for, and that's the passive appreciation. The development side is really the creation of a manufacturing business and making a manufacturing margin. I have my raw inputs that are land, then I have concrete or wood or steel or whatnot, and then I develop the unit, we sell it, and when somebody moves in, we get our money on that day, so it's paid at the end of our developments, and we make a manufacturing margin, we take our money, and we move on.
I mean, and that's when many years ago it clicked for me. Again, I was just so used to, what do you mean development? I mean, how can I get involved as an investor? Do I have to get a hard hat and a hammer and nails? And I'm not good at that kind of stuff. And you taught me about this whole kind of partnership between the everyday investor and the developer, and it just happened to be real estate. But really, it's manufacturing. It could be anything. It's a widget. We could be, creating an automobile. Rav puts money in for this. The maker does this, and we kind of split the profits, right?
Yeah, and I think that the important thing is that, and this is a big distinction in what we do, is who you do it with and the kind of assets that you buy. So, if you partner with somebody who doesn't have a big infrastructure or balance or employees or doesn't really know what they're doing or is buying land where the zoning is risky, it can take a different level of risk than if you're buying stuff inside the urban boundary with 15 of the biggest developers and biggest families in the GTA and in South Florida, and then partnering with them and really leveraging the expertise. Really, in business, if you can have the best go to work for you every day, you have a very good chance of making money. That's the trick, is getting the biggest and the best to work for you every day.
And we're not talking about, $10 million projects here. I mean, these projects are $500 million, give or take.
Yeah, I would say kind of a smaller project in terms of like the gross sellout value to be $100 or $120 million for us, and we've done stuff in the $1.5 billion to $2 billion range in terms of development size. We currently have over $15 billion in development today.
So that's not a small amount. And so those that are watching before they change the channel, how can they, Rav, little old Rav, how can he get involved in this? What's kind of our minimum amounts to be able to get involved?
Yeah, our minimum investments have across our various strategies continue to be $25,000. They're not in increments thereof, but a minimum of $25,000. But we have people who invest $5, $10, and $20 million in a project. We have people who invest $50,000 in the project. And regardless of how much you invest, you just own a larger or smaller percentage of the project and the land, but you won't get a higher or lower return or a better deal or a different deal. My family and I have millions and millions of dollars at any one time in these projects on the same terms and conditions as everybody else. The doesn't matter who you are or how much money you've put up. Yeah,
you're still get the same percentages. It's there. And so these developers, these big developers, because we're doing this in Miami, we're doing this in Toronto, we're doing this in places where you can't really find the land. So is it Greybrook that finds the land? Is it the developer that finds the land? Is it both? How do you kind of bring this marriage together?
Yeah, I think in business, the sourcing of opportunities is really key, right? So not only do we have the pipeline of the thousands and tens of thousands of people that revolve around kind of the Greybrook's universe, but we have the 15 or 20 biggest developers in the GTA and in South Florida that are going out and using their relationships to find on-market deals, to find off-market deals. I would say 80 or 85% of what we buy, we've bought off-market, which means it was never publicly listed for sale. It was through a developer relationship, through a Greybrook relationship, and when we identify those properties, our development team, the developer partner, and Greybrook and our entire asset management team will go in and diligence an opportunity, and then at the end of the day, we'll decide either it meets our criteria or it doesn't. If it does, we'll buy it. If we don't, we're on to the next.
And what I love what you've taught me over the years is that make sure that we're buying under market value.
Yeah,
right?
I mean, I think the way that I put it is, we'd like to be sunset buyers if we can, which means when I buy something, I want to make money before the sun sets that day. But if we're going to pay top dollar for something, we're going to pay top dollar for the best something in the best location, because that's going to have better appreciation value and more development potential and more downside risk protection.
Yeah, and there's a big team that's vetting this, making sure the numbers are going to work. We have a projected, forecast. It's not, just a hope and a wish. There's some really, some due diligence that goes into, is this going to be a profitable endeavor for the investors?
Yeah, there's an immense amount of due diligence. Both our development partners, us internally, but external consultants from lawyers and zoning consultants and architects and designers and cost consultants. I mean, the number of people that see and touch an opportunity before any of our Greybrook investors see it, probably somewhere between 40 and 100 people, depending on a given project.
We are going to take a quick break. We come back, we'll look at the projected returns, how we exit, all that kind of good stuff. Peter, thank you so much for being here. I'm delighted to have my good buddy Peter Politis on the show. Don't go anywhere. Everyday Investor continues in a moment.
Everyday Investor is brought to you by ProFunds Mortgages, fixed returns, real security. Clover Properties Rent to Own. Invest with a purpose. Sam McDaddy Real Estate, full service brokerage for all your buying, selling, and investing needs.
Hey, it's Rav. Welcome back to Everyday Investor. I'm talking to my good friend Peter Politis. We're learning how we can make money investing in real estate development. Peter, thank you for being on the show. You're getting on a flight to go to Miami, right after this. You're a busy man. I love when you come on because I'm always nurtured. I know the audience is nurtured. We were talking about, kind of the different things that we're building, and I want to get more into that. But what is kind of the projected ROI, the return on investment in this kind of whole manufacturing business, if you will?
Yeah, I mean, for our investors, we try to basically double their money every 4 to 5 years. So you're looking at a 20% on a simple annualized return basis.
Okay.
And the returns are really done and received at the end of the development. So there's really no cash flow that is. There's no tenants really. There's nothing quarterly distribution that exists. Development is really a manufacturing process. When that product is delivered and paid for, is when we get all of our money.
Yeah, I mean, there better not be any cash flow. I mean, we're creating something, right? So if Rav invests $100,000 to build this widget, to build this condominium, we've got to build it. I love the fact, and I want you to touch on this, I love the fact that I already know pretty much, in its entirety, maybe 70, 80% of who's buying this. Talk a little bit about how we already have the purchasers for the homes or units before we even break ground.
Yeah, I mean, that's the really key is that typically when we're starting to sell a condo or a housing development here, we pre-sell enough units to already break even or make a profit before we start constructing these things. And from an investor, from a risk standpoint, once you've gotten 70, 80% of your sales and you've kind of fixed your costs as you get into construction, you have a very good idea what it's going to cost to build. You have your revenues, and then you move on from there and deliver. And like we said, get our profit at the end when the construction's finished.
I mean, as an investor, that's fantastic, right? When I look at the cranes in the sky and people say, no, isn't there going to be an oversupply? No, because that's being built for people who have already put their deposits down.
And the vacancy rate in the city of Toronto, as an example, is so low that it's probably bordering on housing crisis low in terms of the vacancy rates. And the thing is that we don't really understand is that outside of Toronto and Miami and other places in the world, they don't pre-sell units. In New York, they're building a building, they've taken a loan, they've taken whatever, they have no pre-sales, then they sell after they build in hopes that people come. That is traditionally how real estate development is done around the world. But it's different in South Florida, Miami, Fort Lauderdale, and here in Toronto.
I mean, here in Toronto, it's roughly, 25% down payments. In Florida, it's even higher, right? Even up to 50% people are putting down?
At that point, I'm really hoping they walk away if they've given me a 50% down payment, but yes.
That's crazy. So we're, in the development space, condominiums, master plan communities, townhouses, but even rentals, purpose-built rentals.
Yeah, I mean, we have a super exciting strategy that we call X-Social Living that we're doing in major urban centers across the U.S. with our U.S. development partner called Property Markets Group, PMG. And it's, we kind of joke internally that we cure loneliness, but it's really a building that's, geared towards smaller spaces lower total dollar rents per month in terms of like what it costs us out of someone's pocket, but we have huge social living areas. Our gym is 2 or 3 times normal. We have tons of programmed amenity space, coffee houses, pools, co-working spaces. We bring people out and we really create a community.
Yeah.
And what we have there is literally, app-powered events. We have goat yoga. If you've never done goat yoga, you got to do goat yoga.
Goat yoga.
Yeah.
I've seen it on TV, never done it.
We have, sushi making classes. We have whiskey tasting events. Basically, it's where everybody, if you're 20 to 39, you'd want to live. And, for us, it's really something that people say they can build a community and amenities are important to building, but we've really managed to do it, several times in South Florida. And our partner is building across the U.S. in Oakland and Denver and Chicago and Orlando and these different places that these are really the next wave of where I think people want to live and kind of the ability to live in these major urban centers for the least total dollars out of their pockets.
And so these, 29, 30-year-olds, young professionals, I've heard there's, the WeWork, you work there, there's a dog park, there's all these kinds of stuff within this community, this complex, so what are they getting? They're getting paint the picture.
Yeah,
what does this person renting?
You can rent by the bedroom.
Yeah.
You can rent a studio, a 1-bedroom, a 2-bedroom. So, if you want to live by yourself and you can afford a studio, great. If you just want to pay for a bedroom and not worry about finding 2 other roommates and not taking on the whole lease by yourself, you can pay a third of the utilities. We include cable, we include internet, we clean the common areas, we clean the common area in your unit if you're renting by the bedroom. And if you're renting by the bedroom, you get your own bathroom. We have co-working spaces, so you no longer have to pay a co-working office. You have, a giant pools. You have all these different things where, you'd think like, okay, it's like a 20 to 30-year-old demographic. You'd be surprised how many 30 to 55 and 60-year-olds we have. We have divorcees. We have people who are moving to new parts of new cities in the U.S. 47 million Americans move out of their state every year. So people are moving and don't have a community, don't have friends. And you go there and you get to meet everyone around you. And you're not just living in your unit, you're living in your building, and it's an amazing community that gets created. And we've had people who start by renting a bedroom, move to a studio, meet somebody, they're renting a 1-bedroom or a 2-bedroom, and we've seen them progress through the...
Why would you leave? I mean, this is a community, and there's going to be a waiting list for people to get into these cities. I've heard you do a talk on this before, and you said, probably, unfortunately, it wouldn't happen in Toronto because of the space.
Yeah, I mean, we have a lot of building restrictions in terms of how we can build our buildings and the amount of space we have to build them, which is not as restrictive, let's say, in places like Miami and Fort Lauderdale and different places. But in a building that is, in Florida that will have 70 or 80,000 square feet of amenity space, in Toronto, that same building will have probably about 7,000 or 8,000 square feet of amenity space. So to create the community and to create the events and to really get everyone out of their units and living together, we just don't have the space. And that's because land is very expensive. It's very tough to build that here in Toronto. We have restrictive building rules in terms of how much space we can do and what we can design. So unfortunately, I don't see that the social living aspect like we've designed in the U.S. coming to Toronto, but our U.S. platform is just amazing.
And is it the same play that we just talked about for the investor?
Yeah, I mean, it's as opposed to selling a condo or a townhouse or a home or whatever, is we're renting these units, we're creating an income, and at the end of the day, a REIT, a sovereign wealth fund, an institution will come in and we'll buy that for the income stream that it'll have in the future. And that's how we make our development margin. So instead of selling the units to the end users, we're selling the income stream to a REIT in the future.
So it's not
still a manufacturing margin.
It's still a manufacturing. We're not in the business necessarily of holding these. We are going to create something significant, and then somebody's going to come along again, whether it's a REIT, institutional, pension plan, whatever. They're going to acquire this, and this would be over a period of.
Typically, it's 3 to 5 years, depending on the size. Sometimes you have a multi-phase project that might be a little longer, but phase 1 will finish and pay out a little sooner. So it really depends on the size of the project.
And same on this rental, ex social living, is it the same projected returns?
Yeah, I mean, again, we try to double our money every 4 to 5 years on the rental side. If we can't make those minimum margins on a conservative basis, the project's just not for us. It's not that it's not viable, it's not that other people won't do it, but we look for probably a little bit of a larger profit margin than your average developer. We're not in the business of just churning and burning low margin development projects because we have people to keep busy. We really look for outsized margin and good returns for what we've done.
And you do what's in the best interest of the investor. I mean, a few years ago there was a property, we were going to build 3 condo towers on it, and some overseas developers came in and said, hey, you've zoned this, it's 3 acres, we want it, and here's the price. and then it made sense to Greybrook and its investors. And was
Yeah, I
sold.
mean, that's a good example. You know, we bought a property for about $60 million. We thought we were going to make about $175 million in profit over kind of a 7-year period. A developer came in and offered us a little over $100 million profit in 2 years. And we said, you know, we'll take $100 million in 2 years rather than $175 in 7 years. We made that trade-off, and it seems to have worked out for everybody.
It worked out. Thank you very much. My kids, thank you as well. But that's interesting though. I mean, we are managing people's assets, right?
Yeah, I mean, I think that's really the key is that, you know, we operate independently of our development partners. While we're their partners, it's our job to oversee the capital, the rights of the investors, and make the best business decisions together. And at the end of the day, our development partners and us make all major decisions together. So we don't give them money and they go off and do what they're going to do and let us know how it goes in 3, 4, 5, 6 years. We're in there, day in and day out, managing this stuff, making trade-offs, making decisions. You know, we're not in the development business, we're in the money-making business at the end of the day. And for us, we've bought land that we intended to build and sold it approved. We've bought approved land to make a building margin. We've bought land with no intents to build and just make a zoning margin. We bought land and turned them into these amazing ex-living communities and made money on that margin. So there's lots of different ways to make money with these partners. It's really about creating a diversified portfolio for our investors. So they get to choose the project that they're in.
Yes, it's not a fund.
It's not a fund.
It's project specific.
Project specific, but for example, if all you want to do is sell luxury condos in Yorkville, that's one strategy, but I would sit there and say we should own some luxury stuff in Yorkville, we should own some rentals in the US, we should own some development stuff in Toronto. The person who's buying a townhouse in Oshawa or a single family home in King or Kleinburg is not the same person who's renting in our ex-living communities in Miami, and it's about getting diversified exposure for your real estate portfolio. You don't just buy one stock, you should invest in various developments.
In a nutshell, Peter, his family, Rav, and friends, we buy the land, maybe a few bucks for marketing, developer comes in, we build something, and generally speaking, we split the profits. And it's in different things, whether it's housing, condo, rental.
That's the general gist of it, yeah.
Peter, I like your style. I thank you for being my friend. I thank you for bringing me along for this ride and being patient with me because I didn't get it at first. I get it. I love it. Thank you so much for being on the show.
My pleasure.
And thank you for tuning in. Without you, we wouldn't have a show. For more information on this show or any others, or to become an everyday investor insider where you can get investment opportunities, tips, advice, go to everydayinvestor.com and sign up. Until next week, we'll see you same place, same time. Honey, I love you. I'll be home soon.